Something we haven't seen in over 2 decades is happening right now. Rent in Canada's most expensive cities is falling. That's right. After years of skyrocketing prices, Toronto, Vancouver, and even Calgary are seeing rental prices drop. But here's the question: is this a good sign for the economy or a warning of what's coming next? Before we continue, make sure to like, share, and subscribe to Economy Explorer so you don't miss crucial insights. Why is rent dropping? The bigger economic picture. At first glance, this seems confusing. Canada is still in an affordability crisis. Housing prices remain historically high, mortgage rates are squeezing homeowners, and wages haven't kept pace with inflation. Yet somehow, rent is falling? It feels counterintuitive, but there are clear economic forces at play. The first and most significant factor is a surge in new housing supply. In 2024, a record number of high-rise apartment buildings and condos were completed, adding thousands of new rental units to the market. Toronto alone saw over 5,000 new rental units become available, while Vancouver and Calgary also saw a wave of purpose-built rental developments that had been in the works for years finally hitting the market. These aren't just a handful of units here and there. Entire buildings are opening at once, each with hundreds of units that landlords are desperate to fill. This influx of new supply has created something that was nearly unheard of in the past decade: rental competition. With more options available, renters suddenly have bargaining power. Large corporate landlords, in particular, can't afford to let units sit vacant for months. Unlike private homeowners, they have financial incentives to get tenants in as fast as possible, which means they're cutting rental prices to stay competitive. Incentives like free months of rent, lower security deposits, and even gift cards are being offered to attract tenants, tactics that were almost non-existent during the rent hikes of 2021 and 2022. The second major factor is slowing demand due to immigration policies and worsening economic conditions. Over the last 3 years, Canada's population exploded by over 3 million people, with the majority settling in big cities like Toronto, Vancouver, and Montreal. This surge in demand fueled the rental crisis, but that momentum is now reversing. The federal government recently slashed immigration targets, reducing the number of new arrivals, and at the same time introduced a cap on international students, dramatically reducing the influx of students who would typically rent in major urban centers. In cities like London, Ontario, and Kitchener-Waterloo, where student populations make up a large portion of the rental market, landlords are already feeling the impact. Fewer students mean fewer tenants, leading to rising vacancies and lower rental prices. At the same time, rising unemployment is making it harder for people to afford to live alone. Canada's unemployment rate climbed from 5% to 6.7% in just 2 years, with Toronto's jobless rate hitting 8.4%. Young renters, the demographic most likely to live in high-rise apartments, are being hit the hardest, as job losses in tech, finance, and service industries have forced many to rethink their living situations. Instead of moving into their own one-bedroom apartments, more people are choosing to move back home, stay in shared housing, or extend leases with roommates to cut costs. All these factors, a surge in new supply, reduced immigration, fewer international students, and rising unemployment, are combining to weaken rental demand, forcing prices down. But the big question remains: is this a short-term dip, or are we about to see an even bigger shift in Canada's housing market? The warning signs: is this a temporary dip or a sign of trouble? Falling rents might sound like a win for renters, but this isn't necessarily good news for the economy. A major concern is that this could signal an incoming construction slowdown, which would have long-term consequences for housing affordability. Developers aren't making the same profits they did before, and with rental prices falling, many are hesitant to start new projects. New condo sales have already dropped to their lowest level since the 2008 financial crisis, as buyers remain on the sidelines due to high borrowing costs and economic uncertainty. If developers stop building due to lower profits and weaker demand, Canada could face another affordability crisis down the road when the current wave of completed projects is absorbed and supply dries up again. A slowdown in construction doesn't just impact future renters. It also means job losses in construction, real estate, and related industries, adding even more pressure to the labor market. Investors, too, are feeling the pressure. In cities like Toronto, 65% of small condos were bought as investment properties rather than as homes. For years, investors made easy money by flipping or renting pre-construction condos, banking on rising property values and strong rental demand. But now, with interest rates at their highest levels in decades, the cost of holding these properties has skyrocketed. Mortgage payments, property taxes, and maintenance costs have eaten into potential profits, while falling rent prices make it harder for landlords to cover their expenses. Many investors who once saw real estate as a guaranteed return are now struggling. Some are selling at losses, while others are holding on, hoping the market will rebound. But if rental prices continue to fall and interest rates stay high, more distressed sales could hit the market, potentially dragging home prices down further. Another red flag is that the broader economy could be slowing more than expected. The Bank of Canada's aggressive interest rate hikes have already put significant pressure on businesses and consumers, and the full effects of these policies are still unfolding. If unemployment continues to rise, rental demand could weaken even more, making it even harder for landlords and developers to turn a profit. A slowdown in rental demand isn't just a housing issue. It's a sign that consumer confidence is dropping, wages aren't keeping up with inflation, and economic activity is weakening. If this trend continues, it could spill over into retail, banking, and other industries, further accelerating an economic downturn. In the worst-case scenario, a prolonged housing slowdown could trigger a broader recession, forcing even more people to delay homeownership, cut back on spending, and remain in the rental market longer than expected. The bigger question is how long this downturn will last and whether policymakers will step in to stabilize the market. If interest rates remain high and new construction slows, Canada could face a housing supply crunch in the coming years, pushing prices back up once demand rebounds. But if the economy worsens and unemployment continues to climb, falling rents could be just the beginning of a much larger economic storm. Trump's tariffs on Canada, how they could make everything worse. Another major economic risk that could impact rent, housing, and the broader Canadian economy is Donald Trump's proposed tariffs on Canada. If Trump goes ahead with new tariffs on Canadian exports, the impact could be severe across multiple sectors, leading to higher prices, job losses, and further economic uncertainty. First, let's talk about trade. Canada is heavily dependent on exports to the U.S., with nearly 75% of all Canadian exports going to America. If Trump imposes tariffs on key Canadian industries, such as automobiles, lumber, aluminum, and oil, it could drive higher costs for manufacturers, lead to layoffs, and slow down the economy. Canadian businesses would either have to absorb the added costs or pass them on to consumers. That means everything from cars to construction materials could get more expensive, worsening Canada's affordability crisis. Housing and rent prices could also be directly affected. Lumber and aluminum are crucial for building new homes and apartment complexes. If tariffs increase the cost of these materials, developers will either slow down construction or raise rental and home prices to compensate. Even though rent is dropping now due to higher supply, Trump's tariffs could reverse this trend by making new construction far more expensive. Then there's the impact on jobs. Industries that rely on U.S. exports, such as auto manufacturing and energy, could take a major hit. If factories and resource companies are forced to cut costs due to tariffs, layoffs will rise, especially in provinces like Ontario, Alberta, and British Columbia. More job losses would mean even less demand for rental housing, as people who lose jobs will either move back in with family or leave cities with high living costs altogether. Finally, Trump's tariffs could weaken the Canadian dollar. If the U.S. imposes tariffs, global investors might see Canada as a riskier place to invest, leading to capital outflows and a decline in the loonie. A weaker dollar means imports become more expensive, increasing inflation and making everyday goods more costly for Canadians. This, combined with higher unemployment and slower economic growth, could push the Bank of Canada to cut interest rates sooner than expected. While lower rates might help mortgage borrowers, they could also signal deeper economic troubles ahead. What should you do? If you're a renter, now might be the best time in years to shop around and negotiate a better deal. With more units hitting the market, landlords are competing for tenants, which means you have leverage. If you're currently locked into a lease, it might be worth checking if better deals are available elsewhere or even negotiating a lower rent with your landlord. But while rents are dropping for now, this window of opportunity may not last forever. External risks, like economic slowdowns, rising interest rates, and potential tariffs, could send prices soaring again. If new tariffs make construction materials more expensive, builders may scale back on new projects, creating a supply shortage in the future. That could push rental prices right back up, tightening affordability once again. For home buyers and investors, this is a moment of caution. The housing market is shifting, and while lower rental prices might seem like a warning sign for a slowdown, they could also signal a buying opportunity before conditions change again. But overpaying in today's volatile market could be risky, especially if demand weakens further due to economic uncertainty, rising unemployment, or a slowdown in new immigration. The real estate market has always been cyclical, and we could be on the brink of another major turn. The big question now is, will rent prices keep falling, or are we standing on the edge of an economic storm that reverses everything? Let me know your thoughts in the comments below. No matter what happens next, staying informed is your best defense against economic uncertainty. If you found this breakdown useful, make sure to like, share, and subscribe to Economy Explorer. Thanks for being a part of our channel. We'll see you in the next one.